Welcome to the Greenard Exchange, the 2017 winter edition. Hope you had a great holiday. I know this last year there's such a focus on different political news, like Brexit and the elections and everything. But overall, I think the year was better than what most investors had hoped for. When I look at the amount of energy and the time that people are spending on the U.S. election especially, there's a bit of a fixation on Donald Trump and the energies and time spent on the news coverage and everything. I know has probably created a little bit more anxiety in people's outlook about before the election and after the election. I think sometimes maybe stepping away from the television and kind of focusing on more longer term components of investing is a better approach, and these short-term outcomes, often at times when there's finality to it, it does provide stability in the markets, which I think many times when before the election was occurring, we saw people coming out with wild predictions, 10% drop, 20% drop. Those people absolutely are focused more on short-term investing rather than kind of looking at the long-term approach. And I think dealing with volatility and everything, you have to stick with good quality names, diversify by sector. You certainly position size is key. Focus on the management of the companies that you're invested in is key as well. Certainly you keep an eye on political movements and everything. You tweak the portfolios. I think it's the small trades that you do, the rebalancing, the switch trades. It's the making sure that you have the asset mix that is appropriate. Those are all the really key things to focus on that helps you manage risk. And like I always tell every client, it's not really you can't control the markets. What you can do is you can control how you react to it. So I think in the last quarter especially, we'll go through the numbers that those people that focused on the long term and focused on having good quality investments in their portfolio, they're once again rewarded. So let's first take a look at the Canadian markets. For the first time in several years, the Canadian market outperformed the U.S. market. Both the Canadian and U.S. markets had a good year relative to most other developed countries. The S&P Composite Index increased 17.5% during the year. Factoring in dividends, the index is up 21.1% for 2016. On December 31st, 2015, the index was at 13,010 points. On March 31st, 2016, the index closed at 13,494 points. On June 30th, 2016, the index closed at 14,065 points. On September 30th, 2016, the index closed at 14,726 points. Closing 2016 out, the index closed at 15,288 points. The year started off with a downward dip in January, but those that stayed the course were rewarded by a significant recovery. The Canadian market was one of the best performing markets around the world, primarily because of its resource-based and stable financial institutions. Brazil, Australia, and Canada all have a strong resource base, all of which had a negative performance in 2015 with a strong recovery in 2016. Although the TSX has had a very, very strong year, we're still not yet back to the levels reached in August of 2014. Tying into the increase in the Toronto Stock Exchange, there is a Bloomberg report that I get at the beginning of every year, and I just received it. And so of the 2,277 point increase in the index, I'm always curious to see which of the large companies in Canada contributed to those and which ones were the laggards or the ones that took away points from the index. So Royal Bank is Canada's largest stock. All the banks are near the top, but you'll see that contributed 192 points. Bank of Nova Scotia, about 176 points. TD, 171. And a couple of the energy names and material names are also on that list, a little bit lower, but definitely what's very dominating on this is three sectors: financials, energy, and materials. On the laggard side, there's only one name there that really stands out, and that's Valiant Pharmaceuticals. That became Canada's largest stock, even surpassed Royal Bank before it ended up plummeting from its highest levels, now down to a share price of about $19.47. That took away about 304 points during the year. Now that we've talked about the leaders and the laggards, I think it's also good just to kind of look at the sectors as a whole. One thing on the chart that I will be bringing up here is that there's going to be a new sector added. It's the real estate sector. That used to be combined with the financial sector. And so this is the first time I've put it on a chart to give you kind of historical numbers on that. So let's bring that up and we'll go through the numbers quickly. The one-year numbers highlight that both materials and energy have been the strongest sectors so far in 2016. Materials is up 39%. Energy is up 31.2%. Obviously, the strength in these sectors is a result of the commodity prices starting to stabilize. Financial services is the largest weighting in the index and also had a very strong year. All sectors were positive in 2016 except for healthcare, which has a very small weighting in the index and ties into that Valiant Pharmaceutical stock we just looked at. The U.S. election's been dominating the U.S. markets, obviously. Everyone's concerned about what's going to happen now that he's elected, and even in the last quarter, who was going to get elected and everything. The S&P 500 has been quite strong, which we've talked about. The Dow Jones is only 30 stocks, and everyone's been watching that to see whether or not it hits the 20,000 level, which would be a record high. But the Dow is only 30 stocks, and I typically like to look at the S&P 500 because it has the 500 stocks listed. Let's bring up the chart. At the beginning of the year, the S&P 500 was at 2,045 points. On March 31st, 2016, 2,060 points. Midway part through the year at 2,099 points. On September 30th, 2,168 points, ending the year at 2,239 points. The S&P 500 increased 9.5%, factoring in dividends up 12%. Of course, the big news this last quarter was the outcome of the U.S. election. The big question before the election was, depending on the outcome of the election, how is this going to impact the stock market? Before the election, as I mentioned, people were predicting declines of anywhere from 10 to 20% if Donald Trump was elected. Those investors who liquidated their investments before the election would have missed out on decent returns in the last quarter. In the last quarter, the index was up 3.3%, factoring in dividends up 3.8%. I think it's really important that investors focus on the long term. The short-term news stories often at times get people's long-term investment decisions off track. With commodities and energy stocks, I definitely agree that trading has to be done. But with the other holdings, the smaller adjustments, switch trades, and rebalancing, like I mentioned at the beginning, I think are the key things while also staying invested for the long run. The sectors for the U.S. is almost a mirror of Canada in the sense that every sector in the U.S. Went up except for healthcare, very similar to Canada. But the healthcare sector in the U.S. is a much bigger part of their index. So, but the drop wasn't. Is a company called Gilead Science was their largest laggard on their side, but they have many healthcare companies that are much larger than the Canadian names as well. But what was interesting is of the 11 sectors, 7 of those sectors had double-digit performance. So the conservative sectors or conservative stocks in the consumer sector did not perform as well, but still had positive performance. But let's bring up the chart and we can take a look at a few of those. The top performing sector in the U.S. was energy, up 23.7%, followed by financials, up 20.1%, telecom, up 17.8%, industrials, up 16.1%, materials, up 14.1%, utilities, up 12.2%, and technology, up 12%. The healthcare sector there was down 4.4%. Also similar to Canada what we really witnessed in the US was people selling some of the conservative names, and they're willing to take a little bit more risk. We often call that sector rotation in our industry. Some people also say it's kind of risk-on type trade, so they sell the conservative names, or risk off, risk on, depending on what they feel the cycle of the market is in currently. So I guess people are feeling a little bit more bullish, and they're willing to take a little bit more risk in some of the underlying commodity stocks. When I look at individual stocks, I often at times compare them to each other, and that analysis is called beta, when you can look at how historically volatile one stock is relative to another. So another term that's often used in our industry is shifting from low beta stocks to high beta stocks. Moving on to international equities, we'll bring up the chart right away here. And one thing that stands out is that all the commodity-focused indexes, such as Brazil and Australia also, they had a positive year. The Brazil was actually the best performing index, up 38.9%. But this was largely recovering from a significant drop in the previous year, where their index dropped 30.8%. In order to recover from a 30.8% drop, I think I mentioned this in my last quarterly exchange, that the index would have to go up 44.5%. So despite the positive year, it still has not recovered from the previous year's drop. Most of the markets in Asia were either flat or down, and the Shanghai Exchange declined 11.3% during the year. There's so much talk about Brexit and how the UK market may or may not do, depending on different votes. And obviously the vote was a little bit shocking to the market, but overall, one of the more positive markets around the world, the UK market was actually up 14.4%. Of course, we're not factoring in currencies and different things, which we'll touch on here shortly. Germany and France were also up 6.9% and 4.9% respectively. Japan started the year off in a very rough fashion, but it finished strong and ultimately finished flat for the year. Now on to the exciting world of bonds. And actually this last quarter there was something to talk about. The interest rates started to move up higher, and it's not necessarily that our central bank raised rates. It's kind of the outlook of where rates will go impacts the yield curve. And certainly there's a bit of I've always said in the past that the U.S. basically leads the direction of interest rates historically. If the U.S. raises, we raise. If the U.S. cuts, we cut. But what we've seen is the U.S. now has raised interest rates twice. We've cut interest rates twice. And Janet Yellen, the Fed chair, has also come out and said, hey, we're planning to raise rates 3 times in 2017. So I think at some point here, the Canadian government is going to be forced to either raise rates, or our dollar is going to keep getting significantly weaker. So, but we'll bring up the chart, and I'll have a couple other comments as we go through the numbers. So this I think is the first time that we've seen the central bank not talk about rate cuts in this last quarter for a while. And I think the communication that was out there in the early part of 2016 was even leading down the path of possibly negative interest rates, which I think that was not very good for people that held certain types of investments, like rate reset preferred shares or wanting to buy additional fixed income investments at the current yields. So what we know for 2016 is that rates were low at the beginning of the year, and they began getting lower at the start of the year. But as the year went on, the rates began to climb, and quite a significant lift percentage-wise at the end of the year as well. So if we look at the 1-month number, a year ago the rate was 0.42. Now it's slightly higher, 0.43. And 3-month number was 0.51, and now it's 0.46. So not much change in the short-term numbers. It's more the longer-term numbers where people feel that rates ultimately probably will get pressured in the upward direction. The 2-year number a year ago was 0.48, and currently it's 0.75. You'll see in September and June numbers there, the rate actually went down to 0.57, and basically doubling almost by the end of the year from the midway point. The 5-year number is at 1.11%. So this, I think a lot of our clients, we have a combination of different types of fixed income investments. And one of the types of investments is a rate reset preferred share. And so this has been very positive for those investments. They have been recovering nicely in value. And if people bought them at lower levels, then they've seen significant gains on fixed income. The downside is that the straight bonds, when rates go up like this, the straight bonds, whether or not it's bought through an exchange traded fund or bought in an individual fashion, those typically have dropped in value since June and September. So, but that's correlation for you. So the end result for us is that we really want to see clients that have diversification, and it's not just on the equity side, it's on the fixed income side. So when one type of fixed income might be doing really well, the others might, but it helps us manage interest rate risk. You'll see the 30-year bond yield, 2.15 a year ago, now at 2.31. The 10-year, it did hit a low of 1% in September 30th, 2016 there, and now it's already up to 1.72%. So these are some significant moves in the last quarter. So with fixed income investments, ultimately you're giving your money to like a company, or you're giving it to a government body. It can be a lower risk type fixed income investment, can be higher risk. This is obviously government bond yields that we're looking at, and I think that's the risk-free rate of return is, so it's going to be on the lower end of yield curves. But it's what's neat to see is that a lot of our investors, they would love to get higher yields on their fixed income, and they're just, the frustrating thing is that you walk into a bank, for example, and you say, I want a 1-year GIC, and let's say it's 1.2%, and let's say you want a higher yield. In years past, you would say, I'd get a 5-year GIC, but if you're only going up to 2-point-something% or 1.8% for a 5-year, that's pretty flat. You're not getting rewarded for committing your funds for a longer period of time. So in our industry, we called that a flat yield curve for many years. So right now, I'm going to bring up a chart, and it's going to show you the yield curve actually starting to steepen. And I think that's more normalized in what it should look like. In looking at the yield curve, you can see that the short-term numbers from 1 month to, say, 3 or 4 years out, they're not really changing all that much. So although people are maybe anticipating that rates are going to go up, there's probably the anticipation that that's going to be happening later on, but not so much in the short term. I do like looking even at the long-term bond yield. Say, let's look at the 30-year bond yield on the chart. And I don't invest in any 30-year bonds or anything beyond 10 years currently, but where that does impact our clients is that banks oftentimes look at that 30-year bond yield and kind of where future yields may be heading. And that's part of their basis by which they set even the 5-year mortgage rates. So I think keeping an eye on that, and obviously in the last year we've seen significant rises in real estate. How do rate increases impact future real estate? So all of these things are pieced together. Moving into the U.S., we'll see that interest rates there, the charts are not as not changing as much as Canada, because obviously they've raised rates twice, and I think they've done a fairly good job of communicating that rates are moving in a certain direction. So we've seen that yield curve more normalized in the States, not only in the last quarter, but the quarters before. So Canada had quite a drastic change in this last quarter. Let's go, you'll see with the US, let's bring up the chart. Looking 1 year ago versus the current date, you'll see every single yield item is higher in the US from a year earlier. A year ago, they were at 1.76%. Now they're currently at 1.93%. The 10-year number, 2.27%, currently 2.44%. The 30-year bond yield, 3.02% a year ago, currently at 3.07. Moving on to the U.S. yield curve, you'll see similar to Canada that we have the current yield in blue and a year ago the yield in red. The yield curve is starting to slope a little bit greater on the end of the curve, which is, in my opinion, starting to normalize. But it's not as drastic of a change as what we've seen with the Canadian yield curve. Moving on to commodities in Canada and around the world, it's the indexes that outperformed in 2016 were largely those that had commodities as a big base within their index. And certainly we talked about Brazil and Australia and Canada is a big part of its recovery is because financials did really well, but also the commodities. Most of them have still not come back to where they once were. But what I'd like to do is just go through the chart and just read through the different changes that occurred on each one of them. And there's only two of them that you'll see that actually declined in value. The rest were up for the year. Copper was up 38 cents a pound. Zinc up 44 cents a pound. Nickel up 54 cents a pound. Aluminum up 9 cents a pound. Gold up $90.85. Silver up $2.06 a pound. Crude oil up $16.68 a pound. Natural gas up $1.38. Heating oil up 60 cents. Gasoline up 40 cents. Corn down 7 cents. Soybeans up $1.26. And wheat down 62 cents a bushel. The second biggest sector in Canada is the energy sector, and the third biggest sector in Canada is the materials sector. So oil going up $16.68 US a barrel was certainly a positive momentum for the energy sector. The materials sector as well, you'll see the two sectors that had gone down are not things that we sell a lot of in Canada as far as a weighting within the index. So the materials like zinc and nickel and copper and coal and those types of materials are certainly a bigger part of the index. And those are the ones that performed the best in the last year. So those are typically more volatile sectors to invest in. And so I think sometimes I explain to clients that if you want a high beta portfolio, higher risk names, then you'll definitely fully participate in performance on the upside when the markets do really well. But if the markets do not do well and you have a significant portion of your investments in those types of sectors, then you're going to see greater volatility. So in a year where someone maybe underweighted commodities and energy, it wouldn't be unrealistic to underweight an index in those years. But in a year where those sectors perform negatively, then it's very easy to outperform the index in those years as well. So it really comes down to kind of smoothing out volatility, and which is something I believe in. And I'd rather have, if the markets are going down sharply, I'd rather try to avoid those in portfolios. And if that means I have to sacrifice a little bit of the upside, if commodities have a rally, then that's the way the portfolios are set up. The last slide that I'm going to bring up here is relating to currencies. And I know a lot of our clients, they like going south for the winters, and they may even be watching this video down south. But I know one thing, over the last year and a bit, it has cost Canadians a little bit more money to go south. And let's bring up the chart and we'll look at it. A year ago, the US dollar was $1.38 Canadian to purchase $1 US. And we did see the US dollar starting to weaken a bit, but as they've been raising rates or anticipating further rate increases, then we've seen their dollar starting to strengthen here. So it closed the year at $1.34 Canadian to buy $1 US. And the euro is, a year ago, was at 0.92 euros to buy $1 US. The euro's weakened a little bit. You'd need 0.95 euros to buy a US dollar. And I guess the one area that stands out with Brexit and everything is the British pound weakening. And that's probably the one base currency that I see it having moved the most. And a year ago, it was 0.68 British pounds to buy $1 US. And it's moving closer to parity. We're now at 0.81 British pounds required to buy $1 US. The Japanese yen has moved around a lot in the last few years. A year ago, it'd be 120 Japanese yen to purchase $1 US. Closing the year out with a large dip in between, you can see. It closed at 116.96. I'm going to close out this video by talking just about a couple things. There's articles I've written, close to 400 now, and that are stored on our website, greenardgroup.com. And our videos are Greenard Exchange, our articles are Greenard Index. And within the index, you can search for different categories. And like one category is managing risk. And one of the articles I wrote many years ago, I think 2008, when the markets began getting volatile near the end of the year, I wrote several articles about risk, and fear has dominated market behavior was one of them. And I actually went through every single year and what people have been fearful of. And I find it a really great article in the sense that there isn't a single year that goes by where there isn't something that somebody's worrying about. And I know focusing on the long term is kind of a key thing that I'd encourage all clients to look at when it comes to investing. The other item I want just to bring up is that this is the time of year where we're doing tax packages for clients, and so last year we sent out 2 packages. We sent out a package that had the realized gain loss report and the fee summary, and then at a later date we sent out the foreign income verification report, the T1135, that new requirement to report that on your income tax return. And so, but this year I've been communicating with our back office, and it looks like those reports, the foreign income verification reports, are going to come out quite a bit sooner this year. And so maybe end of January or early February. So I've put a tentative goal to get all of our package mailed out by February 13th, and possibly even sooner. So, but we're also, this month, we're trying to get in contact with everybody with respect to tax-free savings accounts. And one thing with the discretionary accounts, I just kind of remind everybody that that permits us to do trades within the account, but we still need to get verbal confirmation whenever it comes down to wire transfers to people's accounts, or if we want to move money, say, from a non-registered account to a tax-free savings account, or from a RIF account to a non-registered account. When we're doing those types of movements, we need to get that verbal confirmation for a few different reasons. So if you get calls from either myself or another member of the team, then that's early this year, that we're just either confirming previous instructions or getting instructions for what you're wanting. But wishing you all the best for 2017, and give me a call if you have any questions. Thanks for joining us.